Welcome to Talk Tickers, the show that takes the complex, often chaotic world of financial reporting and delivers the distilled truth right to you.
Today, we are undertaking a deep dive into the corporate profitability metric that simultaneously fuels billion-dollar acquisitions and yet draws the harshest critiques from the world's most successful investors. We're talking about EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization. You see it everywhere.
Everywhere. It's the single most popular non-GAAP metric out there.
And it's used to set valuations for IPOs to structure these massive M&A deals. But, and this is the big but, when it gets adjusted aggressively, well, that's when you hear the phrase BS earnings.
Exactly. Our mission today is to cut through that noise. We want to give you a blueprint for understanding how companies measure and, more importantly, how they adjust their core profitability.
What that all means for true business value and, I think, the hidden risks.
That's it. Because in high-stakes transactions, a company's reported GAAP earnings, they often don't reflect the sustainable, repeatable run rate of their cash flow.
So you need this intense financial surgery, right? The quality of earnings analysis.
Yes. And if those adjustments are too optimistic, they don't just mislead. They inflate valuations and can set the stage for some really severe future stock price crashes. That's the risk we're exploring.
Okay, so let's unpack this. We should probably start with the fundamentals. Yeah. What exactly is EBITDA and what was its original purpose?
So EBITDA is a non-GAAP measure, which just means it doesn't follow generally accepted accounting principles. It tries to show a company's core operating profitability.
Ow.
It takes net income and then systematically adds back four key things: interest, taxes, depreciation, and amortization.
But hang on, that's always seemed a bit odd to me. Why are we treating all four of those the same? I mean, interest and taxes are real cash payments.
They are.
But depreciation and amortization are non-cash. So how can one metric just bundle them all together like that?
That's a great question, and it gets right to its intended use, which is comparability. The whole goal is to strip away items that depend on a company's capital structure or, where it's located.
Okay, so you can compare apples to apples.
Exactly. By taking out interest and taxes, you can compare the operational efficiency of two businesses no matter how much debt they have or what their tax rate is. And adding back D&A, the non-cash stuff, helps you normalize performance between, say, a heavy manufacturing company and a software company.
That makes sense for broad comparisons.
Yeah.
But the second we're in an M&A deal, we're not talking about simple EBITDA anymore. We're in the world of adjusted EBITDA and this quality of earnings analysis, the Q of E.
Absolutely. And a Q of E analysis is very different from a standard financial audit. An audit is just about whether the financials follow GAAP within a certain materiality threshold.
Right.
A Q of E, on the other hand, is done by the buyer, and it's looking for one thing and one thing only: the sustainable run rate of earnings. What should this company actually earn next year with all the one-time noise stripped out? That adjusted EBITDA becomes the foundation for the price.
And this is where we get the famous and frankly terrifying multiplier effect. Yeah. If the deal is priced at, say, 10 times EBITDA, any small mistake in that base number gets blown up tenfold.
Precisely. Let's talk about that materiality gap. Imagine a seller's financials are audited. The auditor says, okay, our materiality threshold is $500,000.
So anything under that, they might note it, but it doesn't have to be fixed.
Exactly. So say the target company didn't record a necessary inventory write-off of $300,000. It's below the threshold, the audit passes, everything looks clean.
The seller says the numbers are clean. But for the buyer doing the Q of E, that $300,000 is still a real hit to sustainable earnings.
It's a real loss. And if that buyer is paying that 10 times multiple we talked about, they are now overpaying by $3 million.
Wow. All
because of a $300,000 oversight that was immaterial to the auditor. That's why Q of E is so critical.
$3 million from a 300-guy error. That explains the scrutiny. Okay, so walk us through the actual process. How do you build this adjusted EBITDA number?
It's basically a three-step process. First, you start with the baseline, EBITDA, as reported, which comes from the net income on the financial statements.
EBITDA.
Second, you scrutinize the management adjustments. These are the add-backs the seller is proposing, claiming they're one-time costs like severance expenses or something.
And I imagine you have to be deeply skeptical here.
You have to be. You need documentation for everything. If they claim a one-time severance, you need to see payroll records, the termination agreement. You need to prove it's actually not going to happen again.
And the third step?
That's the potential adjustments from the buyer's own due diligence. This is where you dig into accounting, quality, inventory, and you really look at management's incentives. Are they just trying to pump up the number to get a bigger check?
Can you give us a really clear example of an adjustment that shows why you need to find that true, repeatable run rate?
Oh, a classic one is non-recurring revenue. Imagine you're looking at the books of a tuxedo rental company in early 2000. Their revenue for the last quarter of 1999 is just massive, off the charts.
Okay, what?
The Millennium Celebration. Everyone rented a tuxedo for the biggest party of the century.
Right. So unless you think Y2K is going to be an annual event, you have to strip that massive revenue spike right out. It's a definition of noise.
Exactly. The whole goal is to isolate the actual, true, repeatable earning power of the company.
But this is where the metric's reputation starts to fracture, right?
Yeah.
When we move from these private M&A deals into the public market, you just can't ignore the criticism from people like Buffett and Munger.
No, and that's where we get those famous, harsh critiques. Charlie Munger, of course, called adjusted EBITDA BS earnings. And Warren Buffett said, references to EBITDA make us shudder.
Their main issue is the depreciation.
Yeah.
They say it's a very real economic cost.
It is. And it's funny, you'd think this metric was invented by some modern CFO trying to pull a fast one, but its origins are actually quite different.
Where did it come from?
It wasn't designed as a measure of economic return at all. It was invented back in the 70s by John Malone, the cable industry pioneer. He used it to help lenders figure out if a highly leveraged cable company could service its debt. It was a lending metric about debt capacity, not a true profitability metric.
And that gets to the core trap investors fall into. EBITDA is not cash flow. A company can have great EBITDA and still be, secretly bleeding cash.
Because it just ignores several crucial, non-optional cash outflows that every healthy business has to deal with.
The most obvious one, as Buffett pointed out, is capital expenditure, CapEx.
Yes, EBITDA adds back depreciation, the non-cash charge, but eventually you have to spend real cash to replace the worn-out equipment. If you don't, you're just borrowing from the future. It's why Buffett asked, does management think the tooth fairy pays for capital expenditures?
Right. The second big blind spot is working capital.
Changes in receivables, inventory, payables, they all use or generate cash, but EBITDA is completely blind to this. A company can delay paying its suppliers to temporarily boost cash flow, but that's not sustainable.
And finally, the two big ones, it literally adds back: interest and taxes.
Both are real cash outflows. You have to pay your debts and you have to pay the government. Ignoring them means you're not looking at what the company actually gets to keep.
So if great EBITDA can mask all this weakness, what's the counter metric? What do smart investors look at?
They look at cash conversion. How efficiently does that EBITDA number actually turn into free cash flow? A low conversion rate is a massive red flag.
And when companies push these adjustments too far, we get cautionary tales. I'm thinking of WeWorks.
WeWorks is the absolute textbook case of this getting out of control. They came up with something called community-adjusted EBITDA.
Right, I remember this. The adjustments were just wild.
They weren't just adding back interest and taxes. They added back core business costs, sales and marketing, general and administrative expenses.
It was, as one analyst put it, a new animal never before seen in the wild.
And by stripping out those costs, they magically turned a real $193 million loss into a pretend $233 million profit.
I mean, that's why the SEC has rules about this stuff.
It is. They force companies to reconcile non-GAAP numbers back to net income, and they specifically ban non-GAAP earnings per share. It's all to stop that kind of misleading reporting.
Which brings us to the really high stakes part of this for public investors.
Yeah.
The link between this kind of aggressive reporting and the risk of a stock price crash. The research on this is pretty clear.
It's very clear. It shows that frequent non-GAAP reporting, especially when the non-GAAP earnings are higher than GAAP earnings, well, that's associated with a significantly higher future stock price crash risk.
And the reason for that is basically management behavior, right? They're inflating how investors see the company, creating an overvaluation that just can't last.
And what's really fascinating is something researchers call the substitution effect. For companies that aren't really prone to, old school GAAP earnings manipulation.
So instead of trying to cook the books, which is illegal and traceable.
Exactly. They just point your attention to the rosier adjusted number. It's perception management.
They're not getting rid of the bad news. They're just hiding it behind this other number.
They're bottling it up until it reaches critical mass. And the frequency of these income-increasing adjustments becomes the real red flag for an investor.
And this gets even worse when executives have a personal incentive.
Oh, absolutely. The risk is much stronger when you see high executive compensation tied to the stock price, or when you see opportunistic insider sales right after they release some optimistic non-GAAP numbers.
So what finally triggers the crash? How does the bad news get out?
It often comes out in subsequent 8K filings with the SEC. These are for material, non-routine events, financial trouble, a change in governance. When that negative 8K hits, it releases all that built-up pressure.
And the pain doesn't just stop with the crash itself.
No, the research shows the negative stock price impact for these firms goes on for at least 2 years after the crash week. It causes long-term sustained damage.
Now, we've focused a lot on the downside, but investors aren't blind. They use non-GAAP metrics for, what they see as valid reasons.
Oh, absolutely. They say it helps them assess earnings quality, it helps with trend analysis, and crucially, they want to see the business through management's eyes. About 42% of professionals surveyed say that's a key reason.
The real problem seems to be when companies label clearly recurring costs as non-recurring.
That's the big gray area. Take restructuring costs. Hewlett-Packard reported restructuring charges every single year since 2009.
Every year. And they still called it non-recurring.
And they consistently adjusted those charges away in their non-GAAP results. If something happens every year, it's not a one-time event. It's just a cost of doing business.
What about those non-cash charges, D&A, the foundation of EBITDA?
Yeah.
How do investors feel about adjusting for those?
Their views are surprisingly mixed. It's not a clear consensus. About a third of investors think adjusting for depreciation is usually appropriate, but another third think it's usually inappropriate. They're a little more tolerant of adjusting for amortization of acquired intangibles, but many still argue it's a real economic cost.
And the one that really seems to get people fired up is stock-based compensation. Why is excluding that so controversial?
Because it's payroll. It's a real economic expense for employee services. It just happens to be paid in stock instead of cash. So most investors, by a large margin, consider excluding it to be usually inappropriate. You're literally stripping out the cost of paying your people.
So beyond the specific adjustments, what are the bigger communication gaps that worry investors?
The lack of comparability is a huge headache. One company's adjusted operating income is totally different from another, so you can't compare them. Then there's what's called undue prominence, when management pushes the shiny non-GAAP numbers in a press release more than the real GAAP results.
And the ultimate red flag is when you tie executive pay directly to those custom adjusted metrics.
That is the ultimate conflict of interest. Discovery Communications did this. They tied CEO bonuses to a metric called EBITDA, which, surprise, excluded stock option and restructuring costs.
So the CEO hit targets and got bonuses that they would have completely missed under the real numbers.
It perfectly aligns incentives to pump up the number they control.
Okay, so if we put this all together, it really seems like EBITDA is both functionally necessary for certain things, like debt analysis, but also fundamentally flawed for valuing a stock.
That is the precise conclusion. EBITDA is useful for specific things. But adjusted EBITDA, especially the kind with frequent income-increasing adjustments, it just demands intense scrutiny. When those adjustments become routine, they're not providing clarity anymore. They're tools for perception management, and that's what creates massive overvaluation risk.
It's that gap between the perception and the reality that gets exploited and eventually corrected by the market, often violently.
Which brings us to a final provocative thought. We know public regulators are watching this aggressive non-GAAP reporting in the equity markets because of the crash risk, but how does this culture translate to the private markets? In an M&A deal, Q/E analysis is everything, but there's almost no regulatory oversight, and management's incentives are perfectly aligned to maximize a single one-time exit price.
So you're saying the private equity firm might buy a company based on these aggressive adjustments, and then years later when they take it public, the new public investors are the ones left holding the bag.
Exactly. The hidden risk compounds in the shadows of the private deal, only to surface later when the company is returned to the public domain.
Something to keep in mind the next time you hear a massive deal announced based on a large EBITDA multiple. Thank you for joining us for the deep dive on Talk Tickers.
You look forward to diving in with you again soon.